This podcast is intended for investment professionals only. All investing involves risk.
Hello and welcome to L&G Talks Asset Management. My name is Andrew Lowry and I'm a content manager here at L&G. This week, we're following up one of the most dramatic periods in the markets in recent years by talking US credit. I should say at this point that we are recording this on April the 15th, and while the pace of events appears to have slowed down compared to last week, please don't hold it against us if anything big changes between now and when you listen to this. To unpack everything that's been going on, I'm joined from Chicago by Jason Shoup, CEO and co-head of Global Fixed Income at L&G Asset Management America, and Anthony Woodside, head of multi-sector fixed income and investment strategy, also in the US. Jason, Anthony, thank you very much for joining us.
Thanks for having us.
Jason, coming into 2025, the big theme was US exceptionalism, and we did produce a big piece of thought leadership on just that theme. However, it's fair to say the policy backdrop over the past few months has challenged this narrative. I think it's a good idea to open with as broad a scope as possible. So can you give us some context for how the US has performed, let's say, since the pandemic, and what it is that's changed this year?
For sure. I think there are, a few ways that the US exceptionalism theme has been or was most evident in markets and in the broad economy. Probably the simplest way to see it is just in the kind of accumulated GDP growth across various developed market economies. And the big standout performer has been the US versus the Eurozone, versus the UK, versus Japan, and to some extent even versus China. Right. So GDP and the performance we've seen over the last 5 years has definitely been a standout. The other really noticeable area is just in how the equity market has traded. And it hasn't really, been just a Mag 7 story or a tech story. It's been broader based than that. The PE multiples on equities have been significantly higher in the US versus rest of world for the last few years in particular. What's been driving that, right? I think that's a fair question. Certainly the resiliency of the US consumer is a big story there. The extent of fiscal expansion in the US has been a driver. The relative insensitivity of the US economy to rates and higher rates, including the housing market as a sector, has been really impressive. And then I would say kind of the icing on the cake has been innovation, right? You've seen innovation not only in AI, but also in things like GLPs and in the pharma sector. And that really created a belief that there kind of was no alternative to the US. The final bit I would say is, in terms of there being no alternative, it wasn't just a US story. It was a rest of the world not necessarily creating as much competition against US assets. Weak growth in the Eurozone, weak growth in Japan, weak growth in China didn't have many investors looking at those markets as attractive as sort of the prospects that were in the US. So it's not fully about how strong and resilient the US had been. It's that there really wasn't much competition elsewhere to kind of draw your capital away from the US. What's happened since the start of this year, of course, is very, very different. And it makes this discussion today, I think, really, really interesting in that we've seen a broad reversal of that there is no alternative. In fact, as I was walking in here, I was trying to find another sort of catchphrase that was equivalent to Tina, there is no alternative. And I thought maybe it's something like anything but the US, right? So ABUS as sort of become the dominant theme. Honestly, I don't know if we've gotten so far as that yet. I don't know if we've sort of given up on the prospects for the US and that there's going to be a continuation of this broad-based move and reallocation away from the US based on the events of the last month. At the moment, you could just say it's a healthy rebalancing, that it's good for the global economy that there are multiple regions where there is attractive opportunities for investment returns. And if anything, you could argue that for the last few months, if not years, financial assets in the US have become really, really expensive, and that this sort of rebalancing is a much needed return to a healthier risk premium in the US for investors in the future.
That's a nicely optimistic view. Anthony, if we turn to credit markets, at the start of the year, there was a lot of focus on historically tight credit spreads. And now that we're past the end of the first quarter, where are we now vis-a-vis valuations and technicals in credit?
Yeah, and I think that's a very pertinent point. As you said, as we've come into this year, we came in with historically tight spreads, and we've seen a few things change so far, at least in the first half of the year. So I think it's important to step back a little bit. So if you look at the last 2 to 3 years, you pretty much had this dichotomy between very tight spreads and all-in yields that were at the highest levels that we've seen since post-global financial crisis. So I think that was an important starting point. There was this tussle between tight spreads and very attractive all-in yields. What we've seen for the better part of the last 2 to 3 years is that the dominant force has been the all-in yield buyer, because you had asset allocators looking at fixed income again and thinking that now fixed income was more attractive tool in the toolkit here. So now if you look at what we've seen so far this year, you still have a pretty attractive technical where all-in yields are very high, particularly in the long-end credit. For example, long-end credit is above 6%. That's very attractive. However, that's being counterbalanced now by elevated policy uncertainty and the fact that there are very real downside risks to growth coming from tariffs and some of the other parts of the administration's platform. So what that has culminated in is you've seen pressure on credit spreads. Whether you're looking at market credit or long credit spreads, you've seen spreads wider by around 20 to 25 basis points year to date. So it is now this push and pull between still attractive all-in yields and then some burgeoning concerns around growth and burgeoning concerns around policy that has been somewhat disruptive to start the year.
Anthony, you mentioned those disruptions. I mean, we got to lean into talking about it. Amid all the flurry of tariffs and tariff suspension, and you mentioned the high degree of uncertainty around the future trajectory for what the administration is going to do, how are you positioning credit portfolios in such an uncertain environment?
Yeah, sure. I would characterize our portfolios as modestly defensive. We came into the year with the view that the markets was giving a lot of attention to the positive aspects of the administration's platform. So think about tax cuts, think about deregulation, which are very business-friendly policies, but perhaps not paying enough attention or giving enough concern to the potentially growth dilutive parts of the platform: tariffs, mass deportation, and DOGE. So we already had somewhat of a more conservative view, particularly in light of how expensive starting valuations were. And I would say in terms of the adjustments that we've been making in the portfolio, in the first quarter of the year, we upgraded the quality of our portfolios. So rotating out of generic BBB risk and trying to more orient the portfolio to high quality single A names that could withstand multiple quarters of elevated uncertainty. And we also have basically been trying to take advantage of the fact that the market was extremely compressed. And I think that lent itself well to that up in quality trade that we've been doing here.
Yeah, it's been an object lesson that sometimes politicians do what they say they're going to do.
Exactly.
Are there any sectors that stand out to you as being particularly attractive or particularly unattractive because of the tariff package?
As always, when we look to optimize sector exposure in portfolios, we really focus on relative valuation as our foremost consideration. However, this year we've certainly increased the weighting for import exposure as a factor in the process, given the very real threat of structurally higher tariffs and the tail risk potentially of a full-fledged trade war should things go south from a negotiation perspective. So when you look at the sector decomposition we have in portfolios, we are overweight utilities and banks, and those are sectors that are less exposed to tariffs. I would also note that utilities in particular tends to be a very defensive sector and tends to outperform in the event that the US economy does have a downturn. And then conversely, we're underweight sectors like tech, pharma, and the auto sector as well. And those are sectors that we feel are more vulnerable to tariff risk here.
Jason, if we can turn to you, where as things stand, we are in the early days of the 90-day pause in the reciprocal tariff program. Can we draw any high-level conclusions at this point about how global trade is likely to evolve? This does feel like the very early days of a potential new era.
For sure. And markets have obviously greeted the 90-day delay in a very, very positive way. I think there are a lot of questions left, right, to sort of work through over the 90-day period. But we do have some basic sort of thoughts or assumptions here. One is it should prove reasonably difficult to put the toothpaste back in the tube, one would think, right? And I think we do expect there to be some reordering of the global trade kind of ecosystem, if you will, going forward. So it would be very surprising to us if all of this is for naught at the end of the 90 days and we see a full rollback of everything that was announced in the Rose Garden a few weeks ago. To that end, we're becoming a lot more convicted that the 10% sort of universal tariffs are something of a floor and probably are going to be a permanent feature of at least this administration going forward. And that what's really being negotiated is the reciprocal tariffs. And a lot of that has been evidenced by the delay or the willingness to delay that as well. What we're worried about, or at least concerned about, is the possibility that even though those reciprocal tariffs for all the nations ex-China have been delayed for 90 days, that the negotiations or what needs to change in terms of what this administration believes with our trading partners is actually quite a high bar to hit. Right? We've heard a lot of talk around the non-tariff barriers to trade. We know that this administration views that, for instance, as something that is a non-economic trade barrier. And maybe the expectation is that that's changeable or negotiable or within scope as we look at permanently rolling back some of these reciprocal tariffs. So those are sort of our major views at the minute. It is interesting on the rollback that it'll focus on China and sort of what the strategy there is. I do think it recognizes sort of something that maybe was obvious or an observation that was obvious to all of us, that it was incredibly ambitious to try to simultaneously negotiate with all of your trading partners at once and do so on sort of an accelerated time frame. It still feels ambitious to get a lot of these negotiations done within 90 days, given things like the North American Free Trade Act or what replaced it took years to negotiate, right? And we were only talking about 3 countries in those negotiations. So there does seem to be kind of like an unrealistic element to being able to get this all completed in time. And if I were the administration, I can see sort of the focus on China here as a way to maybe get broad support or to get Western countries aligned with a more China-focused strategy going forward as well. The one thing I would say that's kind of the final unknown for us, right, is I think everybody would like to be a fly on the wall inside the Trump administration to see how the sausage is made, right? And what we have kind of in our imagination is that there's a wing of the Trump advisors who are really, truly true believers in tariffs and utilizing tariffs to reduce deficits and to reshore and increase the manufacturing sector in the US. And then on the other side, we kind of think that, in our imagination, that there's this wing of advisors who are far more sensitive to the market's gyrations, who are willing to go through the sort of whole tariff negotiation in order to get concessions on the margin, and are maybe willing to, pull back at a point which is less ideological than the true believers would. And I guess in this world, Trump sorts of pivots back and forth between these 2 groups of advisors, and that's how we get what plays out in the press and in the headlines. The real answer is we have no idea if that's really what's going on behind the scenes, right? It very well could be that the sort of ideological focus here will shine through over the next 90 days, and the market is wrong to sort of accept or to believe that the climb down, the backtracking that we've seen by Trump actually is is indicative of a willingness to not follow through, right? And so there's a lot that we don't know. about what the sort of 90-day pause really entails, and we know which way the market's taking it, but it's not clear that that's the way that it's going to prove correct.
I talk of ideology and true believers and radical packages. This is the kind of disruptive ideas that investors generally don't like. Jason, what would you need to see to turn constructive on US credit?
One immediate thing, and then I have one secondary comment, which maybe Anthony can elaborate, or you can go on the Treasury market. The immediate thing, I think the very first deal that we see announced by this administration is going to be tremendously important. And if I was in the administration, I'd be alive to the fact that whatever is the first deal is going to send something of a precedent for all remaining deals. So there's a lot of leverage on that first deal. I don't think we have any idea of when it may come. We don't know if it's going to be with a single country or with multiple countries. That's been hotly debated over the last few weeks as well. And I don't know whether that first deal is going to be obviously positive for risk assets either, right? If the first deal illustrates that the negotiations are going to be difficult and that the rewards are going to be relatively scant compared to what you have to give up, it could be read quite negatively by the rest of the market in terms of what precedent it may be setting for all subsequent deals. If it's very generous and countries are able to essentially get rid of the reciprocal tariffs or the reciprocal part of the tariffs with some modest transactional commitments, it could be very positive for the market. So I think that for us is one of the most important data points or news releases in the coming months, if it indeed comes in the next few months. And there's a possibility that on the back of that, you could become very constructive. There's also a possibility you could become far less constructive too, right? The final thing I would say, and it kind of turns to the Treasury market, is this administration, it's reported, started to become more concerned. And one of the things that really precipitated the 90-day pause was sort of the price action we saw in the Treasury market, right? And the move upward in yields. And maybe Anthony can talk a little bit about that dynamic. But the conclusion to that, I would say, is to the extent the Treasury market starts to firm up and the sort of disorder that we've seen there fades and yields maybe start to modestly move lower in the U.S., you do wonder if that enables a little bit more of a return to a more aggressive approach to tariff policy going forward. So that'll be very interesting to monitor. And I say that in the context of this question is that I think a lot of people would expect that if you saw the Treasury market behaving less volatile and yields starting to reverse some of the climb that we saw over the last few weeks, that would be a reason to be constructive. And I just worry that it may be a red herring. It may actually be a reason to be less constructive if you kind of take the handbrake off of this administration.
Anthony, let's stay on the Treasury market just for a second. It's a market that's garnered a lot of attention in recent weeks. Secretary of the Treasury, Scott Bessent, has said the administration is targeting lower long-end yields. Can you talk us through the recent surge in Treasury yields and just what we can draw from this volatility?
Yeah, I think that's a great point. I mean, the Treasury market is used to being the supporting actor, if you will, to stocks. Market participants tend to be very obsessed about the movement in stocks, and that's generally framing the conversation for where is the Fed put, where is the administration put, things along those lines. We think that this time may be a little bit different here, and the Treasury market is going to be very much a focus of the administration, and they've said as much. So in terms of what you're alluding to, we have seen a particular acceleration in Treasury volatility in the last few weeks in light of the announcements that were made on the reciprocal tariffs here. And given that the administration has made it clear that they want to bring down longer term yields, as they understand that there's a lot of pressure in the housing market that's picking up, there's a lot of pressure around rising delinquencies and credit cards for autos, things along those lines. They want to go out and try to really help Main Street as opposed to Wall Street by focusing and prioritizing lowering long-term yields. However, post these announcements, what we've seen is a material steepening and a bear steepening, and that where yields rise across the curve, but it's more pronounced than the long end of the curve. And we really see a few contributing factors here. So one is the dash for cash for some of market participants here. So who are we talking about? I mean, there's a few proof statements that we can readily point to. So when you look at some of hedge funds' favorite trades, if you look at basis trades, if you look at swap spread trades, there have been very dramatic moves there. And a lot of that's coming from some of the underlying pressures that we're seeing and the need to raise cash and to liquidate trades because of the increase in volatility. So that's one reason. Secondly, we think that risk premiums in treasuries are at the highest point in the last decade. And part of that's coming from the fact that when you think about treasuries, you think about a diversifier, you think about a safe haven, if you will. But when you've seen the price action for the better part of the last few weeks, you've seen a positive correlation between treasuries and stocks here. And that diversification property, if you will, for treasuries is starting to be eroded. If we just jog our memories back to 2022, we also saw that this was something that the market was unsettled by, as well as that positive correlation was very pronounced in 2022 in the aftermath of the fastest hiking cycle that the Fed had done in 40 years. And then third, we see mounting evidence of a broad sell US trade. And Jason alluded to this, in one of his earlier questions here. So when we think about the broad sell-off in US, you've had pretty significant pressure in US stocks. You've had pretty significant pressure in treasuries, so a sell-off there. And then you've had a sell-off in the dollar. Generally, when you have volatile periods, when you have risk-averse periods, you see the dollar strengthening. But this time is different. And to us, this is telling us something about investor sentiment towards the US in general. So kind of evolving from the TINA, as Jason alluded to perhaps investors becoming more skeptical and becoming more wary of US assets here.
Jason, Anthony mentioned the Fed there, and it obviously has the dual mandate of maximizing employment and keeping prices stable, which could mean it's in a difficult position if those goals become in tension with one another. How do you see the Fed's options here? Can you see Jerome Powell intervening?
I think the Fed's in a difficult spot, as you said. I mean, it's probably one of those times where you prefer not to be answering a lot of questions, and that's not really an option for them, right? As you say, I think the Fed has to both think about how to protect growth, or at least protect the labor market, and also contain inflation. And we seem to be running risks in opposite directions there as it pertains to their mandate. You've seen a little bit of what I would call verbal intervention over the last week or two in a very soft way, because it has been not coming with much of a definitive commitment, but sort of an acknowledgement by various folks on the Fed that if there was significant dislocations in the Treasury market, that they would stand ready to, step in. Not a lot of evidence or commitment to what those dislocations need to look like to get them to become involved, or whether we're very close or far away from them, but at least some, a backstop. Which again, I don't think there was any doubt that the Fed would do that if push comes to shove. So we still don't really understand where the line is. Same thing with growth. I think there's, we've had members of the Fed in the last week say that when it comes to weighing, risk to growth and recession versus inflation, the Fed's going to err on the side of growth and rather than inflation. I think that also doesn't come much as a surprise, because if you're going into a recession and the labor market is weakening, you would expect that eventually inflation would fall, even if it's with a very significant lag. But again, all of these comments that we've heard in the last week or two don't really come with much teeth in my mind. They're kind of the way that the Fed should behave and should react. And reiterating it does kind of little to help us frame exactly where that sort of Fed put or might be when it comes to the market. I do think the Fed will be very hesitant to be seen in any way enabling the administration's pursuit of this sort of tariff policy. That's a very narrow tightrope to have to walk. And I do think the Fed's going to be very focused on inflation expectations even if tariffs do raise prices, there has always been the academic argument that that's really just a one-time price rise, and that while prices may go up, it's not going to necessarily create inflation on a go-forward basis. However, the risk has always been that if consumers start to become unanchored in their inflation expectations, which is showing up in some of the most recent data, to be fair, then there is a risk that you get more broad-based inflationary pressure that persists beyond the next year, right? And I think the Fed will be very, very alive to that. And that's where we get stuck. We get stuck in the kind of the scenario where growth slows, but maybe doesn't go into negative territory, and the labor market stays reasonably tight, but inflation starts to move higher, and consumers are concerned that it will continue to do so. And you could see, for lack of a better term, a paralyzed Fed, right? Not knowing whether they should be cutting or should be raising rates, and end up staying steady throughout the whole year.
You mentioned the possibility of a Fed put earlier. There's also been chatter about a potential Trump put. What do you think is more likely to take place, and what kind of market implications for credit would they lead to, do you think?
Yeah, I think for us, the Fed put where we see the two different, either the Fed or the administration doing something. I mean, I guess we'll start with the administration. We already know that a rise in long-term yields was enough to get the Trump administration to think differently about the reciprocal tariffs. So presumably, if we were to see another sort of disorderly rise in yields, or a really deep pullback in stocks, maybe another 15 to 20% sell-off from here, I would imagine that the administration, or that group of advisors who are more sensitive to markets, would start to be louder, and Trump may listen to them to a greater degree, and may look more actively at de-escalation or off ramp. So I think that's there. The caveat to that is, and as I mentioned before, I think the opposite is true too. If the rates market sort of is not showing those signs, or yields are starting to decline, you may actually give a little bit more license for the administration to take a harder stance and backtrack a bit on the kind of de-escalation that they committed to a week ago. And I also think the other bit that's true there is that and there's a lot of reports out there in the press suggesting that President Trump is somewhat willing to risk a mild recession. He just doesn't want a very deep recession. And as we said before, this has been an administration, or at least Trump 2.0 has been an administration where you're supposed to take him at his word, right, and not to second guess him, right? There's been a lot of follow through. The Fed, I think, is pretty easy in terms of where they would become very concerned. As always, I think it's the labor market, right? If you start to see unemployment rise in a kind of concerning way, then I think you're going to see the Fed willing to talk about rate cuts and to more aggressively entertain them. The problem, of course, is that the labor market tends to be a lagging indicator. And by the time the Fed is starting to cut based on a rise in the unemployment rate, usually risk assets are already pricing in some sort of recession, and credit spreads would be significantly wider than I think where they are today. While that sort of counter-cyclical policy from the Fed is welcome, as it would be in any developed market, it's a little bit too late to, I think, to cushion you from sort of downside risks that you may entertain.
Anthony, Jason's just been talking about the chances of a recession. I want to ask you, I mean, I know it's very difficult at the moment given the high levels of policy uncertainty, so this is not an easy question, but where do you see the American economy panning out in the next, say, 6 to 12 months? Is recession inevitable at this point, and what kind of indicators should we be looking at?
So in terms of indicators that we're watching, I would start off by saying that there's been somewhat of a bifurcation between soft data and hard data in the last 6 to 12 months. So if you look at soft data has been extremely weak, and that weakness has really accelerated in the last 2 or so months amidst this tariff noise here. Whilst hard data has been relatively resilient. The hard data does not suggest that we're on the precipice of a material slowdown here, but the soft data is showing that. So in terms of what we'll be watching, we're going to be monitoring and scrutinizing the evolution of the hard data very closely. As Jason already alluded to, the labor market is the linchpin of the US economy. When we look at the dynamics in the labor market, it still appears very solid. So you've seen that payroll growth has been relatively consistent here, but there are a few weak spots that give us concern. One is the fact that the hiring rate remains very depressed here. Two is the fact that when you look at the breadth of payroll gains, it's been very narrow. I would say that one of the things that perhaps mitigates some of those concerns is the fact that the layoff rate has been relatively low here as well. But as we've seen in the past, that could pick up at a moment's notice here. So the labor market is going to be very key to how we evolve it in terms of just the economic momentum in the coming quarters. Some other aspects of hard data, if you imagine, of course, I talk about the uncertainty, and that's really gripping markets, but it's also gripping CEOs and gripping businesses as well. It's very hard to make key investment decisions when policy uncertainty is so high, particularly when it is so imperative for your supply chain here as it relates to tariffs. So monitoring how business investment responds is going to be very important here. And then thirdly, I would be remiss if I don't talk about inflation, right? So far, we've seen realized inflation has been relatively benign, but when you look at inflation expectations, particularly short-term inflation expectations, they have ratcheted higher. So we're very much going to be looking at when these tariffs really filter into the inflation data, how much does inflation pick up here? Because that's going to be very much constraining for the Fed if we see a material uptick in inflation in terms of how aggressive they can be to responding if growth was to slow down. So those are some of the things. I guess the last thing I would point out is the consumer. So as Jason already talked about, the consumer has really been a primary driver of US growth for the last 3 to 4 years here. One of the things that we have talked about before is the fact that the savings rate is at the lower end of the historical spectrum. If given the fact that the wealth effect is becoming a little bit more stressed now because of the downward move in stocks and things along those lines, if the savings rate starts to pick up here, that's something that could lead to consumer retrenchment and also help to slow down the US economy.
The question, though, is if we do get a recession, what's the nature of the recession we get, right? How scared or worried or concerned should we be about it? And right now, you see a lot of consensus around the idea that if we do get a recession, it will be relatively mild, right? It won't be the sort of minus 3% or worse sort of GDP experience that's typical of a kind of a garden variety recession, right? And I guess the question is, why is there so much confidence that you're only going to get a mild recession? And I think some of it is quite logical. One is that this is, by all accounts, something of a self-inflicted recession, right? It's policy-led, and we've already been talking today about the possibility that this administration backtracks. If it's policy-led, you would think that policies could be changed such to alleviate some of the problem if you start to see things worsen considerably more from here. I'd also say another reason for sort of the relative comfort with the recession call and it being only mild is there's not a lot of imbalances in the US economy, right? There's not a lot of apparent, sort of malinvestment that's been made over the last 5 to 6 years that are going to require a period of sort of deleveraging or rebalancing in the economy that could be quite painful and cause job losses and create more a bigger drag on growth, right? So for that reason, I think we and others are sort of the opinion that when it comes to credit markets, yes, could credit spreads go wider if we were to see a recession in the US? For sure. How much wider is a big question. And if it's not all that, severe of a recession, it might not be nearly as wide as we've seen in the past. It might be a relatively shallow dip that you have to navigate. And it's quite possible that when you're talking about the US credit markets from a total return perspective, that total returns are actually positive in a recession going forward, which makes the US credit sort of asset class somewhat more attractive than it would otherwise be if yields were a lot lower as a starting point. The big question, I guess, $1 million question, $1 billion question, $1 trillion question, I don't know what number to use anymore, is how do you get worse than mild? And I don't have the answer to that or the time to think through all the ways it could happen. But we are watching for any sort of non-linear behavior, I guess, in labor markets, right? It's very unusual for labor markets to sort of like gradually deteriorate. By the way, that's exactly what they did last year, right? They never kind of got worse than a gradual deterioration. This time around, if you start to see job losses lead to uncertainty and greater caution, and job losses beget more job losses, and you get sort of a non-linear reaction function, then I think the consumer is in jeopardy, and the possibility that this is something more than mild is certainly imaginable and something that we need to be concerned about. That is not something that we're considering our base case at the moment, though.
So it's very refreshing to hear a relatively level head after the last week or two. Finally, that's obviously a very phlegmatic viewpoint, but what's keeping you up at night? What would you say the biggest tail risk would be to markets this year?
Yeah, there's a bunch. I mean, we've talked about the Treasury yield dynamic, but that one's like squarely in front of everybody, right? And I would say when it comes to tail risks, the things that I worry about most are the things we're not paying attention to. And sort of the working layman's kind of way that markets work that I subscribe to is that the market can only hold so many things at once in its collective mind, right? That eventually you get saturated with keeping your eye on the ball and following different narratives as they're going. And you, at the minute, we're dealing with 2 or 3 things, including tariffs, that have really occupied all the collective brain power. And you have to ask yourself, what's fallen off your list of things that you're watching that could rear its head again, right? And so some of the things that I think, or one thing that I think is really high on that list is geopolitics. Geopolitics is very difficult to have an edge on, but it has not escaped our notice that we're in the midst of negotiations with Iran. There's been a very big buildup in stealth bombers and military presence in the Middle East ahead of those negotiations. It's certainly possible that we see a flare up or an escalation on that front. And then I would say the flip side of that is some of our more adversarial trading relationships. What might they do? What might they do on the geopolitical stage that could cause a more risk-off environment? And I think we should be trying to keep an eye on that just as much as we are sort of what's happening in the domestic agenda here from a policy-making perspective, recognizing that it's very, very difficult to sort of get an edge. But if we were to see something there, it would likely reverberate in a much bigger way because it would come as a complete surprise to a market that hasn't really been focused on geopolitics for the last few months.
Jason, Anthony, thank you for a very broad-ranging view of US credit. Thank you for your time.
Thank you for having us.
Thank you. Have a great one.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of L&G's Asset Management division, as at the date of publication. This podcast is for informational purposes only, and we're not soliciting any action based on it. The information discusses general market, economic, or political issues, or industry or sector trends. It does not constitute research or investment, legal, or tax advice. It is not recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against L&G in relation to the accuracy or completeness of the information contained in this podcast. Where this podcast contains third-party information, the accuracy or completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person in any jurisdiction where such distribution would be contrary to local law or regulations. Copyright 2025. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. Unless otherwise stated, references herein to L&G, we and us are meant to capture the global conglomerate that includes, in the European Economic Area, L&G Managers Europe Limited, authorised and regulated by the Central Bank of Ireland as a UCITS management company pursuant to European Communities Undertaking for Collective Investment in Transferable Securities Regulations 2011 as amended, and as an alternative investment fund manager pursuant to the European Union Alternative Investment Fund Managers Regulations 2013 as amended. In the USA, Legal & General Investment Management America, Inc., a US SEC regulated investment advisor. In Japan, Legal & General Investment Management Japan, KK, a Japan FSA registered investment management company. In Hong Kong, issued by Legal & General Investment Management Asia Limited, which is licensed by the Securities and Futures Commission. And in Singapore, issued by LGIM Singapore Pte Limited, company registration number 2022318776W, which is regulated by the Monetary Authority of Singapore. For full terms and conditions, please visit our website. To find more content, you can check us out on LinkedIn or on our website.